Okay, you're an aspiring options trader. You've read the books, watched tons of videos, but when it comes time to actually placing a trade, the uncertainty kicks in because you're still not sure if you fully understand how options work and the risk that you're about to take on with this trade. Therefore, the purpose of this video is to help you put all the pieces in place to be a more confident options trader and solidify many of the options concepts you've probably already learned about. This is the replay of a recent live Zoom session I did with several options traders just like yourself. And be sure to watch to the end where we get into the backtest program, which really helps you visually understand all the concepts we're going to talk about. And we're starting right now.
So today we're going to talk about just some option basics, moneyness and probability. And we're going to do this by going into the options chain. Some of the things we're going to talk about: moneyness of options. And I know you guys have heard a lot of these phrases before: in the money, out of the money, at the money. We're going to talk about what that means in relation to intrinsic versus extrinsic value. We're going to talk a little bit about delta and the probability of the particular option expiring in the money versus out of the money, ITM versus OTM. And then if we have time, we'll get into a little bit of theta. And really the goal today is just to kind of, it's just a refresher to go through these different pieces of the options chain to better understand when you go to take a trade, what you're actually doing and how those probabilities can kind of take effect. We're going to kind of do all this within Thinkorswim. And I have all these columns configured here. And for those that are Thinkorswim users, you can customize this and bring different columns in. When it comes to all the Greeks and, all the different variables of options, I think these are probably the most important ones to kind of understand. It's the ones that I use. And we're actually going to simplify this as well. It's really the ones that I kind of think about and use mostly. And at some point, I just really end up dealing with delta. And we'll talk about how if you can understand the relationship between some of these things and delta, then eventually when you just look at delta, you'll kind of know all these other things a little bit. So let's talk about in the money options. In the money options are options that have intrinsic value. That's, I think, the easiest way to kind of understand that. And intrinsic value means that these options, if expiration were today, this is the intrinsic value column, and I have this one option selected. I have the 448 call and nothing special about the expiration here. The intrinsic value of this option is $8.15 or so. The value of the option right now, though, is $14.50. So with 17 days left, this option is considered in the money because it has intrinsic value right now. What the intrinsic value is telling you is that if in 17 days, if SPY was still trading at where it's at right now, which is 456 and change, this option would be worth $8. So the only way that this option can go to zero is if the price of SPX were to fall below this, and then it would become out of the money, and then it would go to zero. So on the other side, if we look at an option down the chain a little bit, which is, minimize that. If we go to an option down here, there is no intrinsic value. This is considered out of the money. Out of the money options have no intrinsic value. And if the expiration were today, this option would be worth zero. So if SPX were to expire at 456, let's just call it 456 even, this would be the value of all the options in the chain at that time. Obviously, the market isn't going to expire there, or it's most likely going to expire somewhere else or settle at somewhere else. But this just kind of gives you a glimpse at what you're buying or selling. So the next thing we'll talk about is the extrinsic value. So if you look at the total value of the option, again, we'll come back to the, I think we were at the, it doesn't matter. We'll look at the 446 call option. This option has $9.88 of intrinsic value, and it has $5.80 something cents of extrinsic value. When you add these two numbers together, that's the current value. And if you've read any book or you're somewhat familiar with options a little bit, you understand that there's a premium that's built into the options, and that over time that premium is sort of sucked out of the option. So that's why the tasty trades of the world are going to tell you to be an option seller, which most of the time I'm an option seller, because what we're trying to do is sell this this expensive option. Doesn't even matter which one. We're trying to sell an option, and we're trying to keep as much of the extrinsic value as we can. So when it comes to just kind of in the money, at the money, and out of the money, in the money means there's intrinsic value. At the money means typically the one or two strikes that are just around the price, and usually it has very little intrinsic value, and the first one out of the money. And then out of the money is kind of anything out here. The next thing, once we have the value of the options, intrinsic, extrinsic, that covers in the money, out of the money, at the money. The next thing I kind of want to just touch on is the probability of out of the money and the probability of in the money. And I've noticed, I use Tastyworks a lot too. I'm actually going to move some of my shorter term stuff back to Thinkorswim, but they both have their own sort of calculations. So this probability can actually change. And if we notice right now, if we look at the probability of in the money, that an in the money option, this particular option in this moment has about a 65% chance of expiring in the money. That's what Thinkorswim is telling us. And I'm sure if you look in Tastyworks, it would be pretty similar. Maybe it's 66, maybe it's 64. And the probability of it expiring out of the money is 35%. So when you hear things like, I'm going to take a high probability trade, the high probability trade simply means that you're sort of relying on the probabilities that they're telling you. And typically with being an option seller, the probability that that option is going to expire out of the money or in the money. Most of us don't hold things to expiration. So option alpha and tasty trade and a lot of my stuff too is there's a lot of thought behind closing trades early for capital efficiency, which is a little bit beyond this. But in the beginning, when you open a trade, these are the probabilities. But as you can see, and this is why I wanted to do this session during the day, is that these numbers are always changing. And as soon as the price moves up, like the market right now is down, I don't know, 1.64% or so when we're doing this. And I guarantee you that this option yesterday, this call option, had a higher probability, but since the market went lower, it is now less probable that this expires in the money. So I guess long story short is the probability of in the money, out of the money is a good place to start for strike selection, mostly when you're going to be doing option selling, which is what I do mostly of. And you can get an idea of your probability, and I don't want to say win rate, but it's going to increase your win rate by doing high probability trades. So the way that that's usually done is by selling out of the money options. So if we go down here to, we'll just grab one here. This particular option has a probability, the 465 call. This has a probability of 32% of expiring in the money and 67% expiring out of the money. So you can see the farther you go out of the money, the more probable that it expires out of the money. And there's a lot of risk associated with that, which we can maybe touch on here at the end, but that's the general idea of the probabilities, because if you think about it, if SPX is at 457 and it would have to move, 8 points to get to 465 for this to expire in the money. And even if anyone who's bought in call options before, if you buy this call option for $4 and SPX expires at 465, it's still going to be worth zero because the intrinsic value is zero right now. So the only way it can get intrinsic value is if it becomes in the money over time. And we might be able to go to, we'll look at a risk graph and kind of get a better look at that. But you can use in the money, out of the money for strike selection. So what I've done to make my life a little bit simpler, and I've talked about this on the podcast and various videos, is I tend to go ahead and use delta as a proxy for probability of out of the money. It's not perfect, but if you look at delta and if you look at probability in the money, you can see that a delta 61 option, and calls have positive delta, that the probability of this expiring in the money, according to Thinkorswim, is about 58%. So it's off by, let's call it two points, right? So if I know that this option has a probability of, or a delta of 60, I know that that's more than likely it's going to expire in the money. And on the flip side, if we look at a delta 30 option, that has about a 30% chance of expiring in the money. What that means is it has a 70% chance expiring out of the money. So if you're an option seller, let's say you want to sell this option and try to keep all the extrinsic value, the premium, you have a 70% chance in this moment at the time of this trade of that option expiring out of the money in 17 days, right? Not telling you to, sell a naked option, because again, we're not even talking about risk at this point. But so, if you've seen some of my videos and a lot of the backtest programs, a lot of the strike selection is based on delta. So that also kind of, funneled me into just really looking at delta, about what delta I want to buy or sell. And there's reasons why you would want to buy or sell either one. I do sell in the money options sometimes for different reasons, but I also sell out of the money options. If you're one of my Patreon members, you know that some of the strategies we do a lot of at the money strategies. And the reason why is because there's a lot more extrinsic value here, and the probability is actually still in our favor. So if I look at just this at the money call option, there's $8 in premium here, extrinsic value, and it has a 52% chance of expiring out of the money, right? So there's more meat on the bone the more you go in the money. When it comes to when you're an option seller, you have more extrinsic value that you can try to extract from the market, and that's ultimately what we're trying to do. And the way we do that is by being a net seller of options and using theta here. Theta is the devaluing of this extrinsic value over time, with all other things being equal. So I know, let's open it up for questions again about any of these options, and then we'll go into the risk graph and kind of try to visualize some of this and maybe associate some of the risks. So anybody have any questions about what we just covered?
Yeah, so this is Farouk again. So
Sure.
being a net seller of options, I do understand now if the general trend is upward, meaning we are in a historical bull market, why credit spreads on the put side bring you a little more peace of mind in terms of capital loss prevention, right? And a higher probability of making money.
Right.
Even though puts are more expensive, right? We all know that puts are more expensive. Maybe the premiums may not be as high, but the probability of winning trades is higher.
Yeah,
So,
and we definitely have to attribute that to, and I want to stop short of saying the bull market, but the nature of the way stocks go up and the way stocks go down are a lot different. So stocks go up more slowly and the stocks go down more quickly. So like the COVID crash is a good example, probably the biggest example in my lifetime of the fastest drop, 40, whatever percent it was. It just went down super fast in like a month. So you can't sell a 30-day option unless you nail the top, right? Yeah. If you're halfway through the COVID crash and you sell an out of the money option, yeah, it probably would have expired out of the money, but that rip, you know, it came down and came back up. You're going to be taking a lot of heat. So that's one reason I haven't, you know, I don't sell a lot of call spreads or calls because the market just doesn't stay down that long. Even bear markets, there's a lot of, you know, rallies, bear market rallies that are really tough to deal with. So I did a, and we could, you know, I did a podcast episode, something to the effect of our option probabilities BS. And I think there's a lot of validity to say, yes, they are in a sense. It's really just a starting point. The way I see it is, once you find a strategy, let's say you're a seller of Delta 30 options, that's where you want to hang out.
Mm-hmm.
You're going to be trading differently than someone who sells a Delta 10 option.
Yeah.
It's just a different strategy. If you're selling a Delta 10 put that's way out of the money and you're collecting pennies, you know, in front of the steamroller kind of thing, then someone who's selling Delta 40 like me, we're going to have different entry and exit mechanisms. And so where you hang out on the option chain is going to dictate how you manage your strategy, your strike selection. And I know that's overlooked a lot in some of the stuff that I've put out. For those who've seen, you know, some of, you know, the 7 DTE, some of the 0 DTE stuff, I sell a lot of at the money options and just accept a little bit lower of a win rate, but there's a lot less risk associated with that. I want to do an example, and let's actually flip over to SPX real quick. So
I definitely heard that podcast of yours. I think I've heard every one of them, but that one was a little more on the technical side, and it was just bad timing because I was driving.
Yeah, I know. It's. I want to analyze this trade. Oh, I got a question. Will you show a screen of what to do when you decide on an option that you want to sell or buy? Okay, Patty, we'll come back to that. 45.80. Yeah. Okay. So I'm just gonna put a spread trade here where I'm selling the 45.75 put and buying the 45.70. I'm not taking this trade. We're just going to simulate this at this time. I'm actually looking at this trade, but because the market's selling off, but I'm not entering that. So if we go to the risk profile, this is where everything kind of should start to make sense here. And price slices, and we are going to set the slice by, I like to look at the break even. So in this moment, sorry, I'm trying to spread this out a little bit. Okay, so at this time, SPX is trading for 45.81. Again, everything's going to be moving around a little bit. So if we were to sell the 45.75, this is slightly out of the money, right? So we're a little bit below price because add slice. Because this line is where SPX is trading right now. And this is our break even. So if we're selling the 45.85 and we're buying, I'm sorry, the 45.75 and we're buying the 45.70, this is our risk profile. As long as the market stays up here over the next, 17 days or so, then we would get to keep or collect the net credit, which is the difference between these two. So let me put this back up again. Simulate trades. I'm going to sell vertical. There we go. Okay, so this is doing it in one order. So I can get $1.25 credit, and this is going to jump around depending on the price, but we'll just kind of lock this in place for now. So let's say we could get $1.75 credit. So that is the difference between these two options. And if we go to the, let's go back to the real options chain. We're talking about the 45.75 and the 45.70. the intrinsic value of both of these is 0. So I'm selling one that's more expensive. I'm selling the 45.75 that's 82, or 82 and change, and the other one is about 80 and change. And that difference is what makes the credit. In this case, again, everything's jumping around, but we'll call it, now it's 60 cents, but $1.70 or so. When you start to look at the probability, we know that the short strike of the option, 45.75, over the next, I think it was 17 days, the probability of it staying out of the money is 50.8%. So it's kind of 50-50. It's not a great probability, because the market can move. Our break evens at what's called 45.75 is at 45.83. It's very probable that market could pull back 8 points at some point, and even go lower. So Thinkorswim's pricing this in at just better than 50% because it's just slightly out of the money. And what Farouk was kind of referring to was, in a bull market, which today I would not call a bull market day. Here's just a quick chart of the market. Right now, the market, we're in a bull market in the sense of the long-term trend, but we're in a short-term downtrend. So, the question is, do you want to step in front of the train when it's going lower? And a lot of times these dips can be sold, but you're taking on that risk. Sorry, I'm kind of jumping around over here, but I wanted you to kind of see what this kind of visually looked like, because we're where we end up a lot of times is credit spreads. But even if we were to buy an option, and let's clear this out, and let's just go to like QQQ, for example, and let's say you were bullish for whatever reason, and you wanted to, and we'll come in here so we can see all the fields here. So the trade-off when you're buying options is, how much time do you want to buy? And let's just say let's say we think the market's going to bottom today, and this is QQQ, and let's think the market's going to rally back up to new highs over the next couple of weeks. It's Christmas time. We're going to get the Santa rally, all the things. So we're bullish for whatever reason. So we have to choose, well, what trade do we want to take? Do we want to buy an out of the money option, or do we want to buy an in the money option? And let's call it the 385 versus the 405. So if we go to back to the chain, the 385 is $14, $1,400. It's a lot of money. And if the market rolls over and dies, you could lose the entire thing. However, if the market just chops around and let's say it ends up where it is right now, you would still have $8 left in that trade. So you would be risking $6 if the market didn't go lower, right? But if it doesn't go up, you're still going to lose this extrinsic value. So if you couple that, we said the other one was the 405. Well, the 405 is only $3. So both the value of the option and the extrinsic value is the exact same because it's all extrinsic value. So this is more of the Hail Mary, right? If you want to, we'll analyze this. Sorry, I'm going to buy, analyze, risk. So here's a little bit different chart. So right now, the break even. And so right now, QQQ is trading here at 393.29. The break-even price at expiration is 408, 407 and change. So you got to think, if you plan on holding it to expiration, which you probably won't, but if you were to hold expiration, it actually has to exceed 408 for you to break even, and for you to make money would really need to go above that for you to make money. However, this purple line is sort of the right now line, or the T line they call it. And what that means is if you bought that option today and the market went crazy and went up to this level, let's say it goes up to 410 tomorrow, that $3 option would have a it'd be worth about $1,000, right? Because the $300, you would have a $739 profit. But over time, this purple line is going to fall and conform into that blue line, and that's the theta. That's the premium that's going to get sucked out of that option. But if you get the move before that happens, then you can actually profit from that. But so I think when you're buying options, I think it's less about probability at expiration. You really, in most cases, aren't going to try to hold the expiration. You're going to try to get the move that you're looking for and take profits along the way up there. So I know we kind of got on a tangent there. Go back to the chat. It disappears. So let me go back to Patty's question. Will you show a screen of what to do when you decide on an option that you want to buy or sell? Sure. So, oh, there we go. I'm gonna go back to the option chain. I usually am using Tastyworks, so I'm a little rusty here, but one of the trades, and I've that I usually trade is on Wednesday. Today's Tuesday, so we'll look at options that are 7 days to expiration, but since it's Tuesday, will be 8 days to expiration. And one of the, this is SPX, and usually this is done closer to the end of the day, but when I want to sell, I have a strategy, the 7 DTE strategy, and basically is if, you know, the short-term moving averages are bullish, meaning they're stacked, we consider that the market to be in an uptrend, and we would sell put options that are just barely out of the money, that have a 50-50 chance of profiting, but we're going to use the bull market as our edge to say it's more likely that 50% chance is actually a lot higher, which it is, and we've proven that over time. So what I would do is I would go and look at the delta, and usually I sell 1 or 2 out of the money. So if I sell a delta 49 or a delta 47, I know the study we did was a delta 48, so I might choose the 45.75 as my short strike because that's the delta I want to sell. So the probability of that expiring the money is, would do the delta 48, is almost 51%. So it's just barely out of the money. And so what I would do if I wanted to choose this one in think or swim, I would right click and I could sell vertical, and it would set that up in there that I would be selling the 45.75 and buying the 45.70 in a single order, and the credit in this moment would be $1.80, and that's pretty typical for a 7-day option. And the interesting part about this, and one of the reasons I sell at the money, is because you actually have less risk, because the max loss is the difference between the spread. So let's do that for a minute. I'm going to analyze this trade. So if I sell the 45.75 and 45.70 and I collect the $1.80, and this is a 5 wide spread. So between, 5 wide means $500 or $500. So if I'm collecting $180, my max loss over here, you can see this is the max loss, is $320. So in this case, I would be risking $320 to try to make 180, or at least try to collect and be able to keep some of the $180. So that's the risk reward. So that's an at the money option, just, or just barely out of the money. If we dropped it down, if we go farther out of the money, and let's go back to the option chain. So let's say instead of selling a delta 48 option, we wanted to sell a delta 40 option. Well, the delta 40 option at this time would be the selling the 45.40 and buying the 45.35. So let's go back to the Analyze tab. So we would change this to the 45 135, and we would change this to the 45.40. Okay, so if we go a little bit farther out of the money, we're going to receive less credit, and the credit, and it's kind of bouncing around. It's probably closer to the one, let's like that at 135, right? And there we go. 140. Okay, so here's the same trade, but we've moved the strikes lower. Well, since our credit is lower, instead of the other spread that was closer to the money, this is a little bit farther out of the money, the credit is going to be less because it's higher probability. Our win rate over time should be higher. However, the risk we're taking on is also higher. If we're collecting $1.40, now we're risking $360. So by shifting the spread lower, we receive less credit, and that less credit is added on to the risk or the max loss of the trade. So you can see, and you guys have probably seen this before, for people who like to hang out at really far out of the money. So let's do like a delta 10. Well, we can't go that far. Let's do a delta 15. Let's sell the 43.75. Right, 43.75, 43.70. So if we change this to 43, oops, 43.70, and we'll change this to 43.75. And we can see that our credit is a lot less now. It's only 55 cents. So some people might see that as, you know, more probable, because remember, the price of SPX is way up here. We have a lot more room. It's way more probable that this expires out of the money, because if we go to the 43.75, the probability of out of the money, remember, a delta 16, that means we have about an 84% chance that it expires out of the money. So it's a 16% chance it expires in the money, but an 83% chance expires out of the money. So it's very probable. It's probably going to be a winning trade. The problem is the one time it's not a winning trade, you are now risking $445 to make that $55. So even though people want to do higher probability and they want the certainty of winning, a lot of times people don't understand that even though you have a risk-defined spread and you're you know, you don't have an undefined risk, you're still risking a lot here. So I just wanted to kind of show that probability as it relates to the risk. So yes, you can sell farther out of the money, but you're always going to be taking on more risk even with credit spreads. So I hope that kind of makes sense. Question about probability? Okay, yeah. So Todd, open up the chat a little bit. More certainty equates to fewer profits. More certainty equates to higher risk, I would say. And one thing we can do is, what about selecting a 7D determined by the premium, say $1? Does that go against all the research? It's a good question, George. I don't have the ability to backtest based on the premium. I only have the ability to backtest based on the delta. And for example, we'll do a short sell a put spread. This is SPX. But let's do, I'm going to set this up. We're going to sell a in the money spread, or deep in the money spread, a at the money spread, out of the money spread, and a little bit further out of the money. And this isn't all the way out of the money. It's just to kind of give you an example of selling in the money spreads. And we'll just kind of stick to credit spreads. So this is CML Trade Machine. You guys have probably seen me use this before. Basically, it's going to go through and This is 30 days to expiration, and it's just going to sell these different deltas. Sell delta 50 by, or sell 70 by delta 69. So, and this is the last 2 years. So this includes the COVID crash, right? And we can do longer. It's just, it takes a little bit longer, but just from a general sense, and sometimes you get this one's kind of weird. I would want to kind of examine this one a little bit, but in general, your win rate is higher, right? So you have a 54% win rate for selling in the money, which doesn't make sense, right? None of this makes sense actually. From, if we went back to the option chain and we said, hey, we're going to go out 30 days and we're going to sell a delta 70 put option, right? We're going to sell the 4710. You guys would think I was crazy, right? Because the delta 4710 says, hey, there's only a 28% chance this expires out of the money, right? But the back test is telling us that this won 50% of the time, 54% of the time. No management. This is just, definitely not a recommendation. But if we kind of look at this, and if it kind of follows the market, you can probably improve this, right? So, of course, it loses money during COVID, but when the bull market's running, this thing actually makes money, right? So, and this made $1,700. But remember what we talked about, when you're selling in the money, the risk is a lot less. So if we come here, the average winner was $330 and the average loser was $230. So with a 54% win rate and your winners being bigger than your loser, this is actually not about, that people would kill for this strategy, definitely not a recommendation. But let's contrast that with the Delta 30, which this is the safer one, right? 83% win rate, but look at the heat you take. You lost more in COVID because remember, the risk is more when you go out of the money. It's higher probability. We got that win rate we wanted. We got 83% win rate, but you're risking more on the losers. So this was definitely not as profitable. And again, we're going to have to attribute this to the bull market, right? Because the market goes up. So, that's the spectrum that we have to choose from. So, it's an interesting thing to kind of see this. Now we could say, okay, let's take profits at 50% of the gain, and it's gonna turn a little bit different. I might actually take in the same. So what is universal, I think, is when you take profits early, you improve your win rate. Sorry, was somebody saying something? I'm gonna have to mute you, Regis. Sorry. So one thing that is universal, and this is totally outside of what we're going to cover today, but is when you take profits early, your win rate tends to go up. Right? Not necessarily the profits, but your win rate. So that's kind of where I've landed in my trading, is to say, okay, I can get a 70-80% win rate selling in the money options. Again, this is a small sample, but just conceptually trying to understand that taking profits early as a credit, and then if we're talking about credit spreads, taking profits early actually increases your win rate, right? And actually increase the profits. The other thing that's semi-universal is stop losses. So let's say we want to, when I put a stop loss on here, that'll be 100% of whatever the credit is. So if you received $1.50 in credit, as soon as you lose $1.50, it would close that trade. And in general, stop losses tend to reduce your win rate because there are many cases that the market goes down and then it comes right back up and your trade can actually recover. So by putting a stop loss in, you can actually reduce your win rate a little bit. And I've seen that, you know, and I don't want to say you should not do that. If you're selling delta 10, like way out of the money, you probably need a stop loss, right? But if you're selling in the money, this I get asked this question a lot. How come I don't use stop loss as well? Or how come I don't hedge? You know, if I'm selling, let's go back to this chart real quick. If I'm selling, if I'm selling a spread that's right at the money, my risk is only $330 here for this particular example, right? Because, you know, I'm going to risk change around $320. If I sell farther out of the money, my risk is greater. Therefore, when your risk is greater, you may want to employ a stop. But if I sold that one delta 70 and we sold let's just go in the money, we sold a 46.50 and a 46.45, I've just reduced my risk. Now I'm only risking 250 and I could actually make 250, but the probability is lower, right? So that's sort of the sliding scale. On the stop loss, however, since the backtest only looks at the end of day values, it does not consider intraday moves, which can often trigger the stop loss, which then recovers by end of day. Yes, I would agree. That's one of the limitations to this particular backtest software. A lot of end of day backtest software is it's going to look at the price end of the day. And at the end of the day, it could have actually exceeded your stop loss. It actually has to, because it would have to be greater than the 100%. So if you receive $1 credit at the end of the day, you might have lost $1.50 and it's going to book that loss. So the backtest software definitely has a little bit of glitch, or it's not a glitch, it's just by design. That's one of the reasons you guys have probably seen at my zero DTE. We built an intraday backtester just for SPX, so we could kind of test profits, and we didn't do a lot of stops. I still think stops are they're a little bit dangerous, because a stop, typically you're putting in a market order. When it hits that price, it's going to do a market order, and that can kind of screw you sometimes. But with target orders, you're putting in a limit order, and once you hit that, you get filled, so the risk isn't there. So when you factor all those things in together, I like to sell at the money stuff with profit targets, and I try to avoid stop losses. That's in general how where I've landed with some of this. So before we go, we're going to wrap it up here in a minute. Let's do something. Let's look at the call side, right? So there we go. So selling an at the money call option, and let's even sell something a little bit safer, and we're just going to kind of look at the win rate. If we sell a delta 40 call option, minimize this. So this is the opposite. Here's the call option. We make money if the stock stays down, right? In this case, we would unlock that. Our risk is 235, and our credit's 265. And we were selling let me go back to that. That was the 46.50. So that's a delta 40. So that's out of the money, right? So let's go into the backtest software, and instead of selling a call spread, I'm going to take the stop loss. Let's look at the same things for call spreads. So in this case, we're going to sell a call spread with those various deltas, and we're just going to let it go to expiration. And this is what you end up with. This is in the money. This is an in the money call spread, right? Had a 16% win rate. That was actually, so this is worse than what Thinkorswim is telling us. So let's sell an Delta 40, which is the one we just looked at. Again, 37% win rate, and our winners are a little bit smaller than our losers. So, you know, the farther you go out of the money, the more that ratio matters a little bit. So your losers are 361, your average winner, 50% win rate. So even with a 50% win rate, this doesn't win because the losers are bigger than the winners, right? So, you know, that goes back to the probabilities of, you know, and I don't want to say don't trust the probabilities, but just understand that the probabilities are this moment in time and they don't factor in the bull market, moving averages, news, any of that. It's really just what the market makers and the options pricing, it's what everyone's pricing in. And so we can kind of see over time, again, this is only a 2-year study, but I'm sure, let's go out, we'll go out 5 years on the call side. And it's still, you know, not a winning strategy. Right, so here's the 5-year. So it actually made a lot of money during COVID, but then lost it all back. That's the Delta 70. See, the longer you go out of time, it takes a little bit longer to run these. So while this is running, any more questions before we wrap it up? I know we were kind of all over the place, so I hope this was kind of helpful. But let me know if you have any more questions, and I can stay on for as long as you guys want. I got at least another 20 minutes if anyone has more questions. Here was the Delta 30. The Delta 30 was a little bit more probable because it's a higher probability. But again, the options market on the call side has just been wrong for years. All right, well, if nobody has any questions, I'm going to wrap it up. I hope this was helpful. I'll try to get the recording. This recording is going to be all over the place. So I may have to, maybe I'll chop it up in a couple pieces, but thanks for joining me. If you have any questions, feel free to reach out to me over on stockmarketoptionstrading.net. And obviously, I'd love to have you over on Patreon as well if you want to trade SPX with me. Those membership opens up the first week of each month. Or if you just want to get some of those studies under your belt and ask questions, you can join over there as well. So, all right. Thanks, everybody.